Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, July 5th, 2019. I hope everybody here in the States had a happy and safe Independence Day. I'm back from vacation now, and I wanted to thank you for your patience. Usually I take short mini vacations throughout the year, and this one was longer than most, and was out of contact most of the time. The times I did have Wi-Fi, it was extremely slow. I tried to work a few times. I couldn't even upload charts. Again, thanks for your patience, and just a phenomenal vacation. I'm a very personal person. I don't have a Facebook account other than the site. I don't put up photos and all that or talk about my dog, cat on the site or my kids or anything like that. But if you are interested in going to Costa Rica, whether you've been before or not, I can give you some tips and be glad to share the itinerary that we had. It was just a fantastic vacation that exceeded all expectations. So my wife had found a travel agency locally in Costa Rica who put together everything. You tell them what your budget is and they'll put everything together, and again, just a great experience. So time permitting, I'll talk a little bit about that on the end and be glad to share the contact that we had to book that vacation, as well as the itinerary if you want to kind of do some of the things that we did. All right, let's start out here with the just the long-term charts, and I'll just touch on this. As I mentioned last month, I was waiting to see how the month closed for the month of June. Because we had those bearish engulfing candles back in the month of May. And so in June we didn't close above them, so that keeps that intact as a potential sell signal. When you have a bearish engulfing candlestick, meaning it engulfs the prior candle, the body of this candle engulfs the body of that candle, as well as this previous candle from March. That is a potential topping stick, and what you want to see, obviously, just like on the daily chart, if you were using a daily or weekly chart, you want to see the subsequent candles remain, the body of those candles remain below there, especially closed down below. So that happened last month, and we closed a little bit below the top of the previous candlestick. This month we're a little bit above there, but again, the month is so young it's not even worth talking about this candle yet. A lot can and will happen between now and the end of July, so we'll follow up on that. And as I said before, due to the posture of these long-term charts, I mentioned this before I left town, nothing that could possibly happen last week or this week or anytime in the very near future will change my longer term outlook, which is based again off the monthly and weekly charts. There's not a lot to update here. I just wanted to kind of hit on that as I drill down to the shorter term time frames. Here's QQQ, same story. There's last month's candle that we closed on June last week, and so it kept that potential reversal here with the bearish engulfing candle that's still intact, or in play I should say, and we'll see how this month closes. There's a long-term trend line. So keep it very simple. There's 3 time frames. We can break it down in a simplistic view. The long-term time frame, which is measured in years, that trend is still bullish and remains up as of now. But the divergences and everything else indicate that that trend is most likely in its final stages. And we'll look for a break of these trend lines here. Look for confirmation. Let's see how we close this month, and we'll go from there. So that's what it looks like longer term. Let's drill down as we get still to the long term, but this is now a weekly chart. You can see QQQ still very much has the divergences. We're pointed out here. We had negative divergence, and again, it's not as if these divergences don't play out. They do play out more often than not. Not 100% of the time, but I would say well over 90% of the time. So that played out for the biggest drop that we'd had throughout this entire bull market. The Nasdaq fell over 20%. We pushed up and made a marginal new high. We simply extended the divergences that were in place. And now today, or yesterday I should say, or Wednesday actually, we came in and met that high on QQQ. So we have, as I posted this morning, let's go here. Let's look at the daily chart. We had back here before that big sell-off in the fourth quarter, we had a double top high in QQQ, meaning QQQ made roughly 2 equal highs there. In doing so, it did it with a divergent high, just like we had a divergent high back there in January of 2018. Actually, I should say the second push up in March, and then a sharp correction. We had a divergent high here, and got a little blip which just broke down below the trend, kicked back, and boom, there was the big drop. So we had a similar here. We had a rising wedge. We had almost near divergences, virtually flat on the indicators there, slightly higher. That led to that big drop. And so just like back then, I'm looking at the same thing. I'm looking at about 2 equal highs, you know, roughly. The previous high there and this high here. And also the divergence still and very much intact. In fact, you can see at this point we're making a lower high in both the PPO and the RSI. So what I want to see now, and again, I posted this with the static charts this morning, like to see this PPO crossover, because in my book, and again, this is just how I consider divergence as potential when you have the indicators pointing up as they are now. This is the PPO. It's a momentum indicator, and it's pointing higher. And it could continue higher, and it could take out the divergences. So what I want to see at this point to confirm or firm up the bearish case and maybe get another short entry back on QQQ, I want to see that PPO cross back over, make a bearish crossover below that previous reaction high. That'll confirm that negative divergence, and whether it happens, you know, with another pop up here or we break down sooner, obviously the sooner the better, but we'll see. So right now, let me be clear, we're stopped out of the QQQ official short trade. That's fine, let it go. Even though I had limited access, I had no intention, as I said before I left, to revise that stop again. I put it in place, you know, before I left, after suspending it before, and that's fine. If I, you know, when the time is right, if the time is right, we'll re-enter this. I, you know, just because it was stopped out and hasn't played out yet, I just don't think the risk reward is attractive for going long. So remember, trading is not black or white. You don't have to be bullish or bearish on a position. It's not all or none. Right now, can't make a strong case to short, or a very strong case at least, a decent case. But we'll hold off again on any official reentry. And for those of you, you know, I mentioned in the trading room, I believe it was when I was gone, I was stopped out of approximately half my QQQ, NQ short positions over vacation, stops that were in place before I left, still holding on the other half, because what's happened is we now zoom down to the daily, the 60-minute chart here. Remember, we had this rising wedge right here. We had a correction. It was impulsive. That happened over vacation. I mentioned it looked good there, and there was no follow through. But what happened is, we inched back up, made a essentially an equal high here. You can see the previous highs on QQQ, and we've matched that high. In doing so, just extended the divergence. And so at this point in time, what that indicates to me, although we don't have any sell signals yet, and you can draw a trend line here and a larger wedge, this simply indicates to me a bigger drop than what was priced in here. The bigger the divergence is, typically the bigger the drop afterwards if they do play out. So as I often say, divergences themselves, just like overbought conditions, are not sell signals. They are merely an indication that a trend change is likely. Like back here, you had a trend line that we were tracking, broke down. There's your sell signal back test. That's your second opportunity to short. Another failure at this high, and that set off the correction there. So right now, this is a potential short setup. And this trend line is kind of marginal. I only have 1, 2, about 3 reactions there. Let's look at SPY. And as I always say, even if you're only trading one of the 2 indexes or one index, you want to keep an eye on all of them, at least SPY and QQQ. So there's a trend line right here. This one has a little bit better fit. You can see numerous reactions here on the 60-minute chart. You might be able to pull it up and tighten it there, but let's just give it the benefit of the doubt. Come off the lows right here in early June. Here's a nice wedge forming. So again, if I know I have a lot of lines on the chart, let's make it very simple here. So we had a small wedge here, right there with a divergent high, and it did play it out. In fact, it played out for about the measured target. If you take the widest point of the wedge, which I'm doing right here, add that to where the wedge breaks down, that gives your measured target. So that target was hit. Now, I was expecting more, but as far as the technicals go, it played out for at least a pullback. Now, at this point in time, you have, again, a larger wedge. Here, let me clear out all those trend lines. And you still have the same divergences that were in place have only been extended. And so what that does, it opens the door, or it indicates an even larger correction. Now you have a wider wedge if that breaks, and that could take us down here. if it took us down to the, say, that 289 level, and I'm just eyeballing the measurement, that would and should have longer term bearish implications on those daily charts that I just covered a minute ago. In other words, that 60-minute chart, if it plays out the way you expect, you should see these divergences. I showed you QQQ a minute ago. Here it is on SPY. There's your negative divergence, really no different from what we had back here. These divergences were a little larger. That's the big wedge we had leading into the fourth quarter sell-off. And of course, that again was the biggest drop in years, and over a decade, I should say. And at this point in time, we have just a kickback rally with a marginal new high. There's no umph. You know, that's one thing you look for when the market breaks out to new highs. You look for impulsive buying, and this was everything but impulsive buying. You probably can't see my volume bars. They're down here. You can look at it on your chart. Virtually no volume on this breakout. Remember, this occurred this week on the 4th of July week, which is an abbreviated trading week, traditionally low volume. People are on vacation like I was. It's a good time to take vacation. Kids are out of school and whatnot. And so where I'm going with that is breakouts that occur on below average volume, especially if they don't occur, 1.5 times or better, have a much higher rate of failure. So take it for what it's worth. There's not really any sell signals there. I suspect it'll be a failed breakout, but we'll see. The next objective entry to be short again would be a break of the below that trend line there. And I showed you on QQQ, although the trend line wasn't as firm, it's pretty decent support about 188.37. See the big old gap right here. So look for a breakdown below 188.30 or so, and especially down below this 186 level. That's a really important level, I think, should the market come back in. So if you're looking where to get short or where to add shorts there, if you're looking to go long, again, to me, it's the risk reward isn't good, but if that's your thing, just trail your stops up. And again, you can use the same levels that I might be looking at to initiate or add to shorts as levels to stop out if you are long, playing the trend and believing the market's going to go higher. That's, we drop much below 188.37. Chances are you'll come in and backfill the gap there. And if you drop below that 186-ish level there, there's a big old gap and everything else. A lot of that would be pretty bearish in my opinion as well. So those are levels that bulls or longs can use as stops to try to stay in a trade if you think the market has more upside. Okay, and a quick look at the futures. For futures traders, this is the NQ, NASDAQ 100 E-mini futures, 60-minute chart. So you can see a comparable trend line that I have here, right there, this trend line I'm watching now. And we can play it around, play with that a little bit, move it around, do what I call give it the benefit of the doubt here. If I can grab it, sometimes it's hard on these charts. So come in there and catch that reaction low right around there, and that gives us a little whipsaw signal down through there today. I think the fit that I like better, if I can move that one, these trend lines are really hard to work with here on Interactive Brokers. All right, there's the uptrend right there, and so we're coming in right now for a back test. So on the futures, now I didn't have the same kind of the exact same line on the QQQ chart, but this looks like an objective short entry because we broke down today. If you zoom in here, let me do that for you. We broke down today earlier. It was a pretty impulsive breakdown, which again is what you want to see. That was the sell-off this morning. You can see we had a little move down in the futures, a little bear flagging action, an impulsive breakdown, and we're coming in to back test that line. So while it's not the highest probability entry, it is somewhat objective, especially, again, let's assume that you're starting with a blank slate, you don't have any short position, and you want to be short. Or you're already short the Qs, you gave yourself a little more stops than I did on the official trade, then this would be an objective level to add on with a stop not too far above. You don't want to see that trend line regain. So that's what NQ looks like. ES, or the S&P 500 E-mini futures. This trend line's a little better defined. It's pretty nice. You can see right there, it comes off the recent lows from early June. Come in, you catch quite a few reactions right here, multiple reactions, another one there. And so we have a breakdown, and it's just a hair inside. So ideally, ES should turn down soon, and if it doesn't, then that was a whipsaw signal. And we'll probably go on and pop above the highs again, but it wouldn't really invalidate this trend line because it's just a brief, we're looking at a 60-minute chart here. We only briefly went down below there So we're just a hair above it now. Again, you can play with these trend lines a little bit, come in. Now I moved it to capture that reaction a little better there. So this is basically a back test right here. So again, as I'm doing the video now, an objective short entry doesn't guarantee it'll work out. You can see my next target or first target's down here about 29.55. I think it's a pretty nice area. There's a gap in there. There's reaction lows there, and obviously if that 29.55 level went, then that opens the door down here to about 29.18 or so. And like everything else, you short with a stop maybe just slightly somewhat above the previous reaction high. If they take back the trend line, they'll probably run at those highs, so you maybe have your stop a little bit above there. And it's all about risk reward. Again, minimal downside if stopped out compared to the upside potential. You can see again, these are all potential targets here. Okay, on a related note, not by coincidence at all, when the QQQ trade was stopped out, TVIX was as well. As I stated very clearly when this was added, they are overlapping trades. If you're short the Qs and long TVIX, you have about close to 100% overlap. It's virtually the same thing. The VIX is going to track like the stock market in reverse. So just as the S&P 500 popped to a marginal new high, the TVIX popped to a marginal new low, and in doing so, just like the S&P 500 and the Qs had negative divergence, you have positive divergence. And just like they already had it in place at their previous reaction highs on the market, you had the divergences which have only been extended. So again, nothing has changed from my outlook here. We've yes, the stop was hit and that's it. We'll stay out for now. Some of you already gave it room. I saw some comments in the trading room. If you're swinging for a triple or the fences, you want to hit a home run or grand slam, I still think that's priced into the charts. I see the potentials there. I've added a trend line here. You can see it, a minor down trend line right there, and that's forming this big wedge pattern. So if you want to know when the best objective entry is, always trade. If I'm trading the VIX, you want to trade the markets first and foremost. What I mean by that is you want an optimal entry or a buy signal on the VIX. Then what you want to do is, if you have let's say a wedge pattern in QQQ or SPY or a support level, you want to see the breakdown on the indexes, because if you get, let's say, a breakout in a TVIX pattern or VIX, and the markets at the same time have pulled back to support and then rally from that support, what's going to happen is that breakout in the VIX will probably fail. So again, your Q or entry should be confirmed by the stock market, by QQQ and SPY. Both of those I like to use as far as aligning the trades with TVIX. So there it is. The potential certainly there in the charts to still have those same targets hit that I had from before. What we need now is a little bit better buy or sell signal in the markets. And again, I just covered those levels a minute ago on the futures and SPY and QQQ. Okay, now quick update on a few of the trade ideas recently. Joe, just another great example, right around the same time, I don't know if the same day roughly, that we had the QQQ and TVIX trade stopped out. And again, those losses were much smaller than the gain on Joe. And that's all the trades on the site. You'll notice, nobody bats 1,000. You're going to have some trades stopped out. But the key is, if you want to beat the market, the best way to beat the market is not by trading the market. The best way to beat the market is to run a diversified portfolio and broaden your horizons. You're trading only QQQ, SPY, you're trading the market, and you can beat it, but you're not going to beat it all the time. However, if you factor in, look at the opportunities, the best looking charts in various sectors, different asset classes, stocks, bonds, commodities, gold, precious metals, you not only increase the chance of beating the market, but you're also smoothing out the bumps. So again, any losses on QQQ and TVIX have been more than offset by the gains in coffee so far, which I forget what the percentage was. We entered right here on a break of $33. So at 33.01 back here we were in. Hit the second target. If you're new to the site, at the time we hit that target, I laid out the case that a pullback was quite likely because of the posture of the charts, 60-minute charts especially at the time on coffee futures. And so, some of you, including myself, were able to exit there, get back in. But I always say, if you're not an active trader, I'll list these final targets. That's why I list multiple targets. You can take profits. I said at the time, I believe I said at the time, I expected it to continue on T1. I had no desire to take profits when we hit that first target when we were approaching it, but this one I did. So, you know, it's hard to tell ahead of time when I first lay these trades out which of these levels you're going to have a tradable reaction off of. But once you get there, you can get a much better clue by zeroing in on the 60-minute charts. So you can see right there we had divergence, and it shows better on coffee futures. Again, those charts were all covered. So that's it. So where are we at now? Well, we hit the third target, so a reaction was likely, and that's what we have so far today. I still like this longer term. How far might the pullback go? Let me put a line right there. You can see some gaps. I also reconcile this chart with coffee futures. Remember, Joe is an ETN. All commodity ETNs are simply trading the futures, and I know a lot of traders don't have access to futures accounts. That's why these are the official trades, but personally I'm in KC. That's my trade to coffee futures, and I'll watch that. So look, I can see a pullback. Actually, we already had a pullback to this level once. You can see it's pretty good support, but I think any pullbacks will be relatively minor. But again, you know, at this point in time, you should have, it would make sense to trail up stops. That's the stop from when we entered the trade. But now that we're up here, maybe in an update, I'll move the stop up somewhere. It just makes sense if you're holding out for T4. And again, I may add additional targets. In fact, let's look at the charts of coffee futures. This is coffee seed. This is stockcharts.com. Let me move that over and get the whole chart in here. They use Stock Charts uses a symbol $coffee. It's the same as KC. Coffee futures, a continuous contract. This is a weekly chart. This was largely the case for this trade, and I just want to reiterate again why coffee is not just a swing trade, but also a long-term trade. That's what I could be called a trend trade or an investment. Why? Because this chart shows you here, this is over 2 decades, 20-something year chart. And you can see back here, I look for these trends, these divergent lows, bullish divergence, and the gains on these were very large, probably triple digits on this one. Last time we had a divergent low right here, bullish divergence, and let's see, we had we caught a good deal, that 110% rally of the initial run from here to here. So the point is, coffee, when it runs, it can really run. So as nice as the gains have been so far, my expectation is coffee's probably poised for about close to 100% rally before all said and done. I believe this may be a major bottom, just like this one here and this one here, and as such I may add additional targets on that. Now you're going to have to ride out the zigs and zags. Coffee is a volatile commodity. You know, can move up or down easily, 3-4%. It's up, you know, what was it, up 3% or more today. This is, I believe, an end-of-day chart on Stock Charts, so they only give you the prices. It's not going to update today's prices, but I just wanted to update this one. And you can see here, I've added a downtrend line that comes in right there. It's real light colored. So we have, what we have here right now, coffee's at a pretty important resistance level. It's at this downtrend line. If it breaks out of that, that's even more powerful. This gives us this wedge type pattern, a lot like we had right here. So coffee could be at the end of the run, at least for now, if it can't break out here. But we're in it at a good price. I'm in, at least personally, you know, if you took the trade anywhere close to where it was entered. So I'm willing to give it some room, ride out some pullbacks, and try to go for the grand slam here or the home run. And of course, like I said, just, you know, don't fall in love with it. Doesn't have to do that. So that's what a well-placed stop is for. So that's coffee. Same thing on most of the other ag commodities. I'm for the most part bullish on those. I did an extensive video recently, and somebody over vacation asked me, which I did offer when I did that video, to share the links on these charts. I can do that with stockcharts.com. If you have an account, it'll let you save this chart as your own. If you don't have an account, I believe the chart will still open. You're just not going to be able to save it. So I'll try to post those links as soon as possible. I'm still getting caught up here from getting back on vacation. So that's coffee, and again, there's some other ones, wheat and other things out there that still look good as well. CL, I won't spend too much time in the video because I did a front page update on that. So if you remember the site, that's members only, but you can access that. But pretty much CL has just traded very well to the technicals. I laid it out back here as a setup on a long entry to be triggered on a break of this trend line, which is exactly what we had. There's a great example of trading. If you're new to trading, what is an impulsive move? That's what impulsive looks like. That helps to validate the breakout, the big sharp move that followed. And we went on, and like I said, I had all these targets here. It's been very tradable. We were able to posted some of these updates in the trading room afterwards. You know, a short for a pullback to this level after that 54.76 level was hit. Making a mess of the arrows. Here we go. Let me try to grab my arrow tool. But either way, so that was then, this is now. So we had a lot of opportunities to actively trade or just sit tight. This 58.65 was my initial swing target, and we went up a little bit above that. And when we did, you can see that we started building divergence. And right here, these are the negative divergences that told you that, hey, you know, we're probably at the end of a run, and those divergences, like they usually do, played out for a correction. And as I said in the update today, I am near-term neutral. You know, coffee is really between no man's land, support and resistance. Here's a resistance level, there's the next one, and here's support down here. I stay away from stocks that are no man's land. I like to do one of two things. I like to buy pullbacks to support if the charts confirm, not just for the sake of sometimes you pull back and you break support, but if the charts confirm, that would be a long entry. Or I like to short into rallies into resistance, again if the charts confirm. But right now we're in no man's land, so I stay away from crude and wait for the next objective setup. Nat gas, again, I don't want to go into too much detail. This is a weekly chart, or I'm sorry, a daily chart. Shows you the divergent low right here. And again, it's a wash, rinse, repeat thing. Doesn't mean it has to play out, but you can go back in time and just look at the divergent lows on this chart, which I'm circling, and look at the divergent highs. This is, I don't want to oversimplify it. There are other things that go in, and you want to hone in on entries and exits on the 60-minute charts, but for the most part, you can swing these divergent highs and divergent lows, and so that's the case right now for nat gas. And I know that all of you don't have a futures account, so you can also trade UGAS, which looks like it broke out of this falling wedge today, took out this 1850-ish resistance level, and these are all potential swing targets. But you want to reconcile this with the charts of nat gas. Why? Because there's a lot of decay. I talked about that quite a bit in the past. You can go into under resources, go into the right side of the chart support center. There's an FAQ page. In there, under the ETF related questions, I talk about decay, how it works, and this is one of the worst when you have a very volatile security like natural gas, then add in the 3-time leverage, you're going to get decay. Where am I going with that? Well, this chart looks beautiful up to that level, but I need to see how NG looks if and when it gets there, because nat gas futures, which this is trying to track, may have resistance here, or may have resistance here or here, and so therefore these targets are sort of subject to be changed, let's just say, based on what the futures are doing. Okay, I'm sure there's a few questions on the PAYX short trade. I still very much like it. It's have a kickback rally, which is perfectly normal. Don't forget, you know, nothing goes straight up or down forever. I did an extensive video on this showing you the pattern of these breakdowns, but let's just look back in time. So basically we've had a kickback rally, which is pretty strong. We're still positive on the trade. It's still green. Our entry price was below 85.98. But remember, we were oversold, as I just circled there. Just like we were oversold right here, we were oversold right here, we were oversold right here, we were oversold right here. However, these oversold readings came with divergence at the end of the run. We had positive divergence. That's when you get out. Now, this is, if you look at what happened in the past, and again, this is just a daily chart going back a couple years. See a breakdown here, back test, and you went down and you get these kickback rallies. You get a kickback rally when they're oversold. It's not uncommon. It's not enough evidence to shake me out of this trade or have me modify the trading plan. You know, there was no guarantee that we would have gone up this much, but the odds are pretty good that you get a kickback rally. And if you're willing to sit tight, Stops, I'll leave them where where they originally were put for now. You might want to lower stops at this point in time since it's already broken down. In fact, that probably wouldn't be a bad idea to lower stops somewhat a little bit above entry, or maybe even you could do at entry, but I think a little above right now. I still like the pattern here. But again, the point I'm trying to make here is there's a kickback rally. You can see the breakdown. You had an initial thrust down. We got oversold. We had a little bear flagging action there, and then boom, the next leg down. So sometimes you have to, almost every time you're trying to trend trade or even swing trade, you're going to have to ride out counter trend rallies. And like any trade, it either works or it doesn't work. But I did an extensive video on a lot, not just this daily chart, the weekly chart, making the case for this. And I have still the highest degree of confidence. That doesn't guarantee it'll play out, but I do have the highest degree of confidence that at least this first target, and right now I tell you that's probably my preferred target, T2, pretty decent support there. But we'll see. I'm leaving these as the targets for now. So I just wanted to say that that's, nothing that I've seen so far really changes the outlook of this trade. So we'll leave the stop as is for now, and you might want to lower that again on your own, maybe somewhere around those recent reaction highs. KHC, this is a case sometimes on a trade. I do my best to, when I'm setting my targets, I look at the actual resistance level on a long, which is 3160, and then I'll adjust it down. I did 3153. Why? Because if all eyes see 3160, you're going to have quite often sellers that step in early, shorts that come in and want to short it, and so I do that, and I usually do a pretty good job. If you'll notice, if you've followed me over the years, a lot of my trades reverse right around their targets, have a reaction. This is a case where we hit a high of 3137. Nope, it was higher than that. I'm moving my cursor to the wrong spot. Get it right there. It was 3150, I believe. There it is. 3148. Where is it? Yeah, I guess that's it. I could have sworn I saw 3150 recently. Either way, 3148. So we're talking pennies, basis points, well under 1%, fraction of percent. So what I'm getting at, for all intents and purposes, that level has been hit, and so we've had the expected reaction, but the stock's holding up pretty well. I want to say this: if you were targeting T1, we keep getting pushbacks right up to that level, a little shy of it. So you've had several opportunities, and you still could exit because this stock could go either way. I'm still leaving the second target on for now, 33.59. In fact, the first target hasn't been hit technically, so it's still an active trade without hitting the first target yet. What I'm watching for, and what concerns me a little bit, is you guys probably know I love to use the PPO signal line. The 9 EMA is a trend indicator. When a security is above that level, the trend is bullish, and when it's below, as it crosses from here, bearish. And that's the white line. And that zero line often acts as resistance when tested from below, and so that's what's going on now. So the bearish case would have a rejection here, and we go on to make, KHC remains in the downtrend. The bullish case would have us get that PPO solidly get back above that trend line. For now, there's not enough evidence in the chart to modify anything on the trading plan. I'll leave 3153 is the first target. That's the second target. If it can punch up through there, this is still a potential, I should say, third target there, the downtrend line. And again, this is nice. And what I need to do too is make an adjustment to this trade, because this is a dividend. Let's see, did they cut their dividend already? No, still has a nice dividend. And so what happens? This is fine to me. This is a growth and income trade. If we get caught in a sideways range like this for a while, as long as we don't get stopped out, all just as well, because this stock is kicking out about an 8% dividend yield, and I have to look. I'll have to see when it was paid. That may have also knocked down the stock, because in other words, where we would have hit our target had I done a price adjustment. Because when you have a stock, once it goes ex-dividend, when they declare the dividend, they're going to pay it out. You know what it is? The stock, all of the things being equal, the stock price will drop by the amount of the dividend that is coming up to be paid once it goes ex-dividend. So therefore, I hadn't done that adjustment. I maybe should adjust the price targets based on that again. I'll take a look later, but just wanted to kind of update that trade and saying right now status quo. It's hanging in there. I'd like to see it stay above this line, this recent level of consolidation. Otherwise, there's a big old gap that may be backfilled there. Obviously, I don't want to see that happen, but I want to mention that if we break below the recent lows, that opens the door for a possible backfill of the gap down to about 29 or so. Okay, last but not least, and this is not an all-inclusive list, just some of the trade ideas I've thrown out recently. This one I put out there while I was on vacation because it looked to me it was ripe for a breakout, and sure enough, I think it was the next day or shortly thereafter, it did break out with that impulsive green candle. Again, that's impulsive. That's what you want to see. I don't know if you can make out the volume bars below, so we had everything I like to see: an impulsive move on above average volume, confirms a breakout, ran right into my first target, which is resistance around 21.23, where it's been consolidating since. So far so good. Hard to say where it goes, but if it can break above the recent highs, that opens the door for a move up to 22.47. Otherwise, a failure here takes us, and maybe we get another long entry on a back test. That would be a next objective entry if it were to fall down there. I have no idea what it does, but I can tell you if it takes out that previous reaction high from, what would that be, Wednesday, that would most likely open the door for a move up to my next target around 22.74. And if it breaks much below the recent lows, probably come in for a back test. Keep in mind, biotech stocks, particularly your smaller biotechs, not your big mega cap biotechs, the small ones that have everything riding on just one or a few drugs. This one has a peanut allergy drug in the pipeline, phase 3, I think, waiting for approval. These smaller biotechs have a tremendous amount of risk, so just keep that in if you are trading this. Means if something comes out bad on what's going on, that peanut allergy medication, and it's not going to get FDA approval, this stock could go down 50% or more in a day, could gap down. Likewise, it could gap up that much as well. So just keep that in mind when trading small biotech stocks. The chart is very constructive. You just can't get around the risk of sudden clinical trial FDA denials or positive or negative results in clinical trials. They come out of nowhere. So how do you manage that? Well, here's a stock that has the potential. If it heads up, let's just say it gets back to its old highs, it's 100% gain. It's double your money. So there's a lot of potential built into this stock. And what you do, just take a small enough position size that if you wake up to a 20-30% gap down, it's not going to kill you. Just like the TVIX trade. The percentage loss was big, but the beta adjusted loss, because I said that at best about a 1/3 position size, it made it for a typical normal loss, because you're taking a much smaller position size, really, because losses to me in percentage term mean nothing. It's how much money do I lose in dollars. So therefore, I'll always do those beta adjustments to my trades. All right, let's wrap it up here. It's been a long video. And no time to talk about the trip. If you're interested, going to Costa Rica, like I said, and you want to see, the travel agency we used, or the itinerary, some of the excursions we did that I would recommend, just drop me a line and I'll be glad to share that information with you. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.